Hi there, how you doing? How's everybody doing? Today we're going to do a video about portfolio performance measurements or measures. The most important one and the ones that most likely would be on the CFA exam level 2. So the second exam, I believe at least one or more of those measurements that we're going to discuss here today could be on your exam with high probability. Okay, some of those you have seen already on level 1, but I think they're going to be more testable on level 2. Okay, so we're going to see. So I would have here 6 different ones. In my opinion, those are the 6 you need to know for the exam. So let's see. Let's start and see which ones we have here. I'm going to go show you a list, and then I'm going to go one by one. Hi friends, so let's see what do we have here. We have the portfolio performance measures, and we have here a list. So what do we have here? Sharpe ratio, Trainor ratio, Sortino ratio, information ratio, Modigliani or M&M2 or M square adjusted portfolio measurement, Jensen's alpha or J alpha. Those are the ones that you need to know. Each one will give an indication. Some of those measurements better than the others. Some of those measurements take a different approach and therefore includes other components on evaluating the performance of a portfolio manager. And the other ones do not, right? So we need to be aware here which ones are what are the pros and cons of each one, and which type of risk each one will take in consideration when evaluating the performance. All right, so let's start it. So portfolio performance measure, what are we measuring, right? What are we measuring here? Well, we're measuring the performance of portfolio managers, right? So how the managers did, right? One did better than the other, and how do we know that? So the first one will be the Sharpe ratio. It's a measurement of total risk. The second one will be the Trainor ratio, which is a measurement of systematic risk, and the Sortino ratio, which will be a measurement of downside risk. So the 3 first ones that I'm going to explain one by one very shortly, it follows the premise, follows the idea of excess return divided by risk. Those are the first 3 ones. Excess return divided by risk. The information ratio, it's similar, right? But it's an adjusted risk performance, right? So it's adjusted for risk. So it's an adjusted excess return divided by risk. So it's adjusted. I'm going to explain that, okay? M&M2, right? Also is an adjusted risk measurement, right? So it's adjusted for the risk of the market. Finally, the Jensen's alpha, it's a measurement of additional return. Okay, so Jensen's alpha, it's measure alpha, the extra, the additional return made by the portfolio. Reminding you here just a couple of things. The M&M and the Jensen's alpha are the only 2 that have the answer in percentages. Okay, the other ones, the other ratios, the one that has the end with the word ratio, then they're going to be presented as a decimal or 0 point something or 1 point something, and sometimes above 1. Okay, but the idea is that not in percentage, but in decimals, right? So that's the only just a what do you call convention how to present the numbers. Okay, now we're going to go one by one. I'm going to explain to you here, the characteristics, the pros and cons, right, for each one, and then we do we're going to do in the end a wrap up, right, with all of them, and that's what we have. So let's see here. Hi friends, so put a little bit there. Okay. Perfect. Let's do this. All right, first one. It's that I have here is the Sharpe ratio. Right. So let's talk about Sharpe ratio. Okay. So Sharpe ratio is a measurement, the performance that includes total risk. Is a total risk approach. So what is the total risk approach? The total risk approach includes all the risks. So systematic and unsystematic risk, right? So let's imagine all the risks that one individual stock may exhibit, okay? So that's the approach. That's why you use the standard deviation. And on the numerator is what I mentioned before, is an excess return. So the excess return, which divided by the standard deviation, is the Sharpe ratio. Now, pay attention on the excess return measurement. It's the return that the manager did or made minus a benchmark, right? Remember that I said here, excess return, right? This is a generic formula. Excess return is the return minus something, right? Minus a benchmark. The benchmark for the Sharpe ratio is the risk-free rate, okay? And the risk associated to that measure is the standard deviation, right? So return minus risk-free divided by the standard deviation. What are the pros and cons? Well, the pros, it's very intuitive to measure performance that way, right? Excess divided by the risk. Oh, right? If this number is above 1, that means I made more return for unit of risk that I incur, right? So that's logical. The problem is that the benchmark is the risk-free rate, okay? It doesn't give you much about risk, right? The risk approach, the risk adjusted return, okay, that's one. And the standard deviation is a measurement of a total risk, right? In a diversified portfolio, we don't have a total risk, we only have the systematic risk. So that's some of the inconvenience of the Sharpe ratio, but nevertheless, very well used. The Sharpe ratio is well used. You're gonna see in active portfolio management theory, which is out of the scope of this video, but next video I'll talk about it, would be the inclusion of the Sharpe ratio to identify the optimum risk, right, of a portfolio. What is the optimum Sharpe ratio of a portfolio? All of those formulas are very much possible that you're going to face it in questions on the CFA Level 2 exam. All right, let's go for the second one, friends. Second one, the Treynor ratio, right? Treynor ratio is a measurement of systematic risk. So this one is a performance measure for portfolio managers that adopt a diversification approach. Well, if it's a diversified portfolio, then systematic risk would be a better way to measure the risk. Not total risk, but systematic only. Systematic risk is beta, right? Beta is the measurement of systematic risk. Therefore, we do the excess return divided by beta. That's Treynor ratio. It's a better measurement better, I wouldn't say better, but it's more applicable for diversified portfolio. That's positive. But the problem is it's still the risk-free rate is the benchmark, right? The risk-free rate is a benchmark. It doesn't give you much. We need a different benchmark. We need a more comparable benchmark associated to that return. For example, if it's the return in one stock only, it wouldn't be the case here because the Treynor ratio used the systematic approach. So that's more for diversified portfolio. But if let's say on the Sharpe ratio again, right? And on the Sharpe ratio, instead of the risk-free rate, we use some kind of benchmark more associated to the return of that stock, right? To that stock, something that would kind of track better that stock. That would be a better way to measure. Okay, so there you go. That's the inconvenience of using the risk-free rate as a measurement or as a way to measure excess return. All right. The last one on the same line, right? Which line? The excess return divided by some kind of risk unadjusted, right? Unadjusted excess divided by risk is the Sortino ratio. And the Sortino ratio, it's a measurement, performance measurement, only focus on the downside deviation. What is the downside deviation? Well, the deviation that the returns are going to go below a certain target. I don't care what happens to the returns that go above the target, but I'm concerned in understand what happened or how many times, what is the frequency or anything that tells me regarding the returns that were above the expected. So that's what the downside deviation measures. And again, it presents kind of the same problem as the previous two measurements, is the fact that you use the risk-free as the proxy, right, for that. In downside deviation, also, it's telling you the manager performance regarding only the missing target, but still, it ignores also the positive, right? It doesn't say anything what happens to the returns that were above the expected, just the ones below. So again, it's a very specific performance measurement, and it also doesn't give you the whole, it doesn't measure, let's say this one, the whole qualities that a portfolio manager will have, because it's just taking into consideration the downside deviation. All right, let's go to another one. It's a little bit better. That's the information ratio. That's very much likely that could be on level 2 exam, right? Information ratio, right? It's present, right? It's like it's not only present, but I would say that's kind of like fundamental to have the presence of the information ratio on portfolio management material for the level 2 exam. You have the active portfolio management, right? You have a reading, right? Entire reading module, if you may, on portfolio management material of the level 2 exam that talks about the information ratio and how to use the information ratio, right? How the information ratio relates to the fundamental law of the portfolio management, etc. Right? So very important to understand the information ratio. Now, this video here is just to explain it to you how to use the information ratio as a measure of performance. However, it's a very important ratio that you need to go deep to understand very well, because questions related to the information ratio most likely could appear on your exam. All right, what is the formula? It's a better measurement because instead of the risk-free rate, use a benchmark, a specific benchmark. Okay, that's better. A benchmark here will be an index that tracks better that investment or that stock or that group of stock, or etc. Okay, so that's a better measurement. An active risk is a measurement of risk that's for each unit of active return, how much active risk, additional risk, let's say, was taken to generate that return. The idea is always keep the return, generate the active return, the alpha return, above the active risk. If the manager can keep that, obviously the information ratio will be higher than 1, right? Now, if the return to increase 1% return, you have to take 2% of risk, well, then this ratio is also demonstrate that that's not that of a good of a performance. Yes, it generated 1% of active risk, active return, which is good, but you incur 2% or more of active risk to do so. It might not be in the interest of the client to have a portfolio manager with that performance, right? With too much risk to increase the active return. All right, so that's the information ratio. Like I said, very important ratio in finance, a very important ratio on the level 2 exam as well. All right, next one here is the Modigliani, right? Franco Modigliani, Leah Modigliani created, right? Grandfather and granddaughter created that risk-adjusted performance, okay? It's also a good risk performance measurement because it's used adjusted risk. So pay attention, huh? Adjusted risk, it's preferable than any kind of risk, like total risk or systematic risk, right? Or downside risk. We're replacing now to some kind of a adjusted risk measurement, right? So we're adjusting the risk. In this case here, it's exactly what it is. We're taking the M&M2 or M square, excuse me. It's the Sharpe ratio, but corrected for that imperfection that I mentioned before, because the Sharpe ratio, it doesn't tell you because using the risk-free rate, right, is not telling you much what is the comparison of that performance with the market itself. So the M squared comes to fulfill that need. So if you take the Sharpe ratio of the portfolio and multiply by the standard deviation of the benchmark, now we're using a benchmark. Benchmark would be an index or some kind of other portfolio. Use it as an index, and then added the risk-free rate. Okay, that would give you the performance of the portfolio management. Well, the idea is to have the highest as possible, right? We added the risk-free rate because we presented as a total. Okay, but even if you don't add the risk-free rate, we still could infer if one manager did better than the other just by taking a look on its Sharpe ratio, then the Sharpe ratio, adjusted for the standard deviation of the benchmark. So you make an adjustment. So it's called risk adjustment. I'm adjusting that Sharpe ratio now, including the standard deviation of the benchmark. Let's put it there, right, and see what happens. Right? So that's how we do the M square. And finally, friends, the Jensen's alpha. Okay, Jensen's alpha. Right? It's the only one of those ratios. It's not a ratio, really, right? It's a number, right? So it's an additional return. It's a percentage above the expected. That's what the Jensen's alpha is. So I just put it here, very, very simple. The return should be equal to alpha plus the expected return by the CAPM, the capital asset pricing model. So that's what I put there, alpha plus CAPM. So the Jensen's alpha, it's not this formula here. For this, to get the Jensen's alpha, I have to isolate it, the alpha, right? So I have to kind of like isolate it, right? The alpha. So here I'm going to just kind of like put it this way. I'm going to put alpha equal the CAPM, which is the expected return using CAPM, right? The capital asset pricing model, minus, actually, let's put the other way around. Right? Let's put the return made by the manager minus the CAPM. That will be better, right? So you can use either or, right? I like this because it's more intuitive to me. Return equals alpha plus expected return given by the CAPM. Or isolated alpha, just put the CAPM on the other side with a negative, then alpha, the additional, is the return minus the expected return. If this number is positive, the manager created alpha, right? Created more return than the expected to the client, right? Now, it is a systematic risk measurement because it's using beta, right? I'm using CAPM, obviously I'm using beta, okay? But still, it's not adjusted for the risk of the market, for any other risk. And it's just a monetary measure, right? It's telling me alpha is 10%, it's 20%, but it's really not saying much about how much risk was incurred to actually generate that alpha. And the client might be expecting to know that. Okay? So of all of those ratios, there you go. Let's do a little kind of summary here. We have the Sharpe ratio, which is a measurement of total risk, and the formula is the expected return. It's actually not the expected return, right? It's the return. So let's put that E out of there. There we go. It's the return minus the risk-free rate, right? And divided by the standard deviation, okay? Now, the measure of the trainer ratio, it's very similar, right? It's again the return minus the risk-free, exactly as the Sharpe, but now I'm dividing by beta, right? The Sortino ratio, same category, right? Let's put that one there. There you go. So if I do the return minus the risk-free rate, right, I'll get the excess. And now I'm only interested in dividing that excess by the downside deviation. So the downside deviation is the one I'm using for the Sortino ratio. So the return minus the risk-free rate divided by the downside deviation. Finally, the information ratio. Again, same idea, but instead of the risk-free rate, we use a benchmark. Right? So I'm going to put here the actual return minus the benchmark divided by the active risk, right? Or active return minus the benchmark divided by the active risk. Very important information ratio for you to remember for the exam. All right, the last two. The M2 is the Sharpe ratio times the standard deviation of the benchmark time plus the risk-free rate. And the Jensen's alpha, right? Or alpha is that the return is going to be equal to alpha plus CAPM, CAPM, or expected return, okay? In any way. So you need to know for the exam, right? The names, the formulas, because they're easy to memorize, and the type of risk that each one will kind of like include or use on the approach, okay? If any. Remember that the adjusted risks are the best ones, okay? So they're more meaningful because they're adjusted, right? The systematic, it's also good because it's implying that we have a diversified portfolio. In the measurements of total risk, like the Sharpe ratio, are more indicated by one asset, individual asset, right? Or even you could get the Sharpe ratio of a portfolio to use as a measure, right, of how to compute the active weights and other components, but still, right, the information ratio would be more advisable to use in case of active management, right, to measure the return that the active manager generated for its clients. Okay, let's see. I think I covered everything. I think I did. All right. So that's it. That's going to be the end of the video. So the idea here is just to present you the most important performance ratios, explain one by one, going to show the connections, right, and the important points. Because remember, on the exam, don't expect that you have to calculate the ratios. I mean, you could expect that, but I don't think it's likely, right? I think it's going to be likely that you're going to have to interpret the ratios given to you, right? Or answer conceptual questions related to those ratios. Not necessarily a simple mathematical computation, right? You already have level 1 to demonstrate your ability to do something minus something divided by something else, right? So I don't know if the level 2 would be wasting your time by asking questions when you have to do those simple calculations. I think it's going to be more intelligent than that. I think the questions are going to be more deeper than that. Something that you have to think, something you have to analyze, not necessarily something that you have to calculate and demonstrate your abilities of using the calculator, okay? You have level 1 to do that, because level 1 you have 180 questions, right? So you have more time and more questions to ask you to show, for you to demonstrate your mathematical abilities. I think level 2 is going to be, because it's shorter. We have here a much shorter, have 88 questions. We have then less possibility to ask you questions. Consequently, the questions have to be done in a more intelligent way to measure your knowledge, right? Because we need chartered financial analysts. They're able to think, and they're able to make decisions, right? And we're able to make sure that the machines can do the calculation for you. Okay, so there you go. So now we're ending here with the ratios. Now, one little note here on a funny side, I guess, right? But notice that those measurements of risk, with exception to the M2, because it's a little bit more, the other ones are very, very easy to get the intuition. Right? It's an axis divided by some kind of measurement of risk, right? So there you go. If you're actually able, if you were born, I don't know, 60 years ago or more than that, you probably could be able to come up with some of those measures and then have your names stated right before the word ratio, and then you create it. Something that, if you think carefully, is simple, right? Axis divided by risk. It's a very simple way to measure the performance of the managers. Right? Well, that's it, friends. I'm going to stay here. I hope this video was helpful. Right? I hope the comments that I made here were helpful for you to kind of like get some tips for the exam. And again, any questions, anything I can help you, to pass those exams, the CFA exams, I'll be more than happy to do. So get in touch with me, get in contact, make suggestions for new videos. If there are some points of the any CFA exam, level 1, 2, and 3, please ask, and I can make those videos. For those that are following me, we have videos from level 1, 2, and 3. Our playlist is divided in videos in Portuguese and English. So the followers on my channel and they follow my lectures and my classes in English, just go to the playlist in English, right? Assuming that your Portuguese is not that great yet, and vice versa. If you're a Portuguese speaker and your English is not that great or is not there yet, although it should be, you can watch the videos in Portuguese as well. But that's the idea. It's always same to make some content on both languages and eventually produce more in the English content. My Portuguese audience knows that because the exam is in English, right? So it's important that we get comfortable with the terminology, the way to present and how to speak. Because although the exam is not going to ask you that, it's not a oral exam, right? So you don't need to worry about speaking. It's important in the future when you do networking, right? If you want to speak with your colleagues around the world, we're going to have to speak in English because that's the common language that put all of us chartered financial analysts together. Okay, friends, that's it. Like I said, I hope you had enjoyed this video. Please send your suggestions, comments. We'll be more than happy to hear. Take care. Bye-bye.